Talk about Credit Suisse, which is facing a crisis of confidence.
1 year, shares of Credit Suisse have fallen by as much as 60%.
Switzerland's second biggest lender knowingly managed hundreds of millions of dollars for suspected war criminals, corrupt autocrats, and drug dealers.
Executives are discussing reducing thousands of jobs globally.
We are in a very challenging situation. We need to address that.
It's a tale of scandal after scandal.
Investors fear there will be a repeat of the 2008 financial crisis.
Credit Suisse is one of the oldest and the most famous banks headquartered in Switzerland. It is not a small bank. At the end of 2021, Credit Suisse reported over 1.6 trillion Swiss francs in assets and it employed over 50,000 people. The Financial Stability Board, which is an international body that monitors and makes recommendations about the global financial system, named Credit Suisse as Global Systemically Important Bank, which means the failure of this bank would cause significant harm to Swiss economy and financial system. Clearly, Credit Suisse is too big to fail. But now, it looks like Credit Suisse is on the verge of failure, and some experts say a negative outcome is likely to cause a shock similar to that caused by the bankruptcy of Lehman Brothers in 2008, which, as all of us know, has triggered one of the most serious financial crises. So, how did Credit Suisse end up in deep trouble? And will Credit Suisse be the reason for the next financial crisis? Let's understand in this video. Credit Suisse is basically a bank which also ventured into investment banking and asset management business. It's been around since 1856 and it is one of the biggest banks in the world. It played a main role in shaping the Switzerland's economy over the years by giving loans for the development of both Switzerland and European railway systems. Back in 2008, when most global banks were in deep crisis, Credit Suisse came out unscratched. That was the time when big American banks like Bear Stearns and Lehman Brothers went bankrupt. Simply, Credit Suisse was unaffected by 2008 housing crisis. Escaping this crisis had made Credit Suisse too careless. Unlike other big banks, Credit Suisse did not learn from its mistakes and it's paying its price 14 years later. But the fall of Credit Suisse did not happen overnight. It's been building over the years. And now, when the global economy is going through tough times, the bank's weakness is clearly visible. There are a series of events which led to bank's downfall, but mainly it can be attributed to three major events. The first big crisis for Credit Suisse happened when Greensill went bankrupt in March 2021. Greensill was an Australia-based financial services company and Credit Suisse has sold billions of dollars of Greensill bonds to investors. The bank has assured investors that the bonds are of very low risk. Credit Suisse invested $10 billion in these bonds. Finally, when the company went bankrupt, a number of investors have sued Swiss Bank over the Greensill-linked funds and Credit Suisse still not able to recover its losses. Credit Suisse lost $5.5 billion when an American company, Archegos Capital Management, defaulted in March 2021. The business, which was owned by a person called Bill Hong, was heavily funded by Credit Suisse. This hedge fund took high-risky bets on certain technology stocks with borrowed money. It backfired and Archegos Capital went bankrupt. Eventually, Credit Suisse ended up with losses of $5.5 billion. Back to back, two companies went bankrupt and it costed Credit Suisse $15.5 billion. In search of profits, company lost its way and took too much risk. The third problem involved slush money, or the money used for illegal activities. Credit Suisse handled cash for drug dealers and is facing criminal money laundering charges. The bank was also fined 350 million euros over Mozambique tuna bond scam, which was a loan arranged for the Republic of Mozambique, where the loan was issued to buy boats for the fishing, but the majority of the money went into the pockets of government officials and Credit Suisse employees. Things could have went really bad for Credit Suisse as it was the second largest financier for the failed Chinese real estate giant Evergrande. Fortunately, it learnt its lessons and exited well in time. With all the scams and management failures, company's business was hit hard. In the last 1 year, when all global banks were reporting record profits, Credit Suisse reported combined loss of $4 billion in the last 3 quarters. A year ago, Credit Suisse had a market capitalization of $22.3 billion. Its current market capitalization stands at $10 billion, around 1/10 the market cap of HDFC Bank. Credit Suisse shares fell 60% in 1 year to $3.98. In recent days, employees' morale is at all-time low. The bank has not yet renewed contract of certain contractors. Employees who left are not being replaced. The biggest source of worry is credit default swaps or CDS. So what are these credit default swaps? Let's understand with simple example. Companies can raise debt in two ways. They can either take a loan from the bank or they can issue bonds. Assume that a company wants to raise 100 crores through bonds from public, but a single person won't be able to give all that money. So they divide these 100 crores into units of 1000 rupees each. These units are called bonds and they are sold to public. It's a kind of crowdfunding in the form of debt. The company pays interest on these bonds, and when the bonds mature, the company will pay back the principal amount. Sounds good, right? But there is an issue. What if a company defaults on the repayments? That's where CDS come in. CDS is a kind of insurance which protects bondholders against the default risk. Simply means if a company defaults on its loan, these insurers will pay the money to the investors. In return, they will charge a premium just like insurance premium, which is expressed as a percentage or basis points of the bond price. 100 basis points is equal to 1%. Riskier the bond, higher this premium gets. And now the premium has gone about 250 basis points, which is higher than the CDS levels of Credit Suisse at the peak of the global financial crisis in 2008. Currently, the banks like Morgan Stanley and UBS have CDS levels below 150 basis points. In probability terms, the Credit Suisse credit default swaps are pricing in 23% probability of bankruptcy. This is scarily high and raises the speculation of Credit Suisse becoming Europe's Lehman Brothers. So that's the story of how Credit Suisse ended up in deep trouble. But the burning question is, will Credit Suisse fail? And if it fails, will it lead to crisis similar to 2008? Well, it is highly unlikely. Let me explain why. 2008 housing crisis happened some 14 years back, and we have learned our lessons. Regulators have framed some strict regulations on money management for banks. For one, today banks are not allowed to rely too much on short-term debt. Short-term debt is a debt which company need to pay back within 1 year or sometimes just few days. If a company relies too much on short-term debt, it can prove dangerous for the company. It can be understood from Lehman Brothers example. If you see this chart, 77% of the Lehman Brothers debt was short-term, and when 2008 crisis happened, bank lost all the money. Suddenly it was out of cash and majority of its debt need to be repaid within 1 year and few days. Bank had no option but to file for bankruptcy. Instead, if it had relied on long-term loans, things could have been different, as they will have longer period to pay back this money and these sources are more stable. When it comes to Credit Suisse, the banks dependent on short-term debt is very low. It means Credit Suisse will be able to manage the situation. When Lehman Brothers went bankrupt, 77% of their funds came from short-term sources. Compare that to Credit Suisse, 13.5%. After 2008 crisis, regulators have come up with some important capital requirements called liquidity coverage ratio and net stable funding ratio. Without going much deeper into these concepts, these ratios ensure that the bank had enough money to deal with crises like what we are seeing today. Liquidity coverage ratio for Credit Suisse is 191%, which is among the best in class. What does it mean? Essentially, Credit Suisse is placed comfortably and will be able to manage this crisis. Does it mean that Credit Suisse is out of trouble? Not exactly. The bank is going through crisis and the damage is done. My point is this crisis won't be as bad as 2008. For Credit Suisse to survive this crisis, a lot will depend on how restructuring plan is presented by the management of bank on 27th October, when Credit Suisse will announce its September quarter results. Most certainly, the restructuring deal may either will be to sell off the investment banking business or spin off into a separate entity. That will allow Credit Suisse to preserve the value of the core banking and wealth management business. Every now and then, we find companies going out of business, maybe due to economic factors or due to mistakes made by the company in the past. But not always, they will have a ripple effect through the financial system. When 2008 housing crisis happened, it was more of a systemic issue which happened due to reckless risk management. In case of Credit Suisse, it is more of a company-specific issue. In the age of social media, rumors spread like wildfire, and with the involvement of CDS, which were the reason for 2008 crisis, the panic was doubled. But the numbers don't lie, and sometimes the popular opinion is not the true one. So do your own research before you believe in anything. Thanks for watching this video, and if you feel this video is informative, please hit that subscribe button and share it with others. See you in the next one.